Okay, welcome to another run through of the top 5 charts of the week. So what we're going to do is just go through this free weekly email and add a little bit of extra comments and explanations. So first one here is the global manufacturing PMIs. We've just had the data in for September, and this is quite an interesting chart, I think. What we've got here in the black line is global manufacturing PMI composite, GDP weighted, excluding US. And then we've got the US there as well. And you can see that there's this very noticeable divergence. Some might even call it a decoupling, and it's reflecting a lot of things that are kind of shaping global markets at the moment. So, for example, the slowing in Europe and China and emerging markets. At the same time, the strength in the US economy. I mean, the US economy is looking stronger than ever. And, you know, this really is, as I've noted here, reflecting some of the divergent asset market performance trends that we're seeing. So US equities versus global, and it's also it's reinforcing driver of that divergence. So, one I think consequence of this kind of gap that we're seeing here is going to be a stronger US dollar, stronger still, and that in and of itself is going to cause pressure on places like emerging markets, which is only going to add to that kind of divergence. So I think this is a really key theme. One thing I would note is, these kind of divergences tend to be very much temporary in nature, because sooner or later the consequences of that divergence on global markets will tend to kind of resolve it. So that's a key one, really. Key one to stay on top of. Now, one of the ones that I mentioned on the slowing side there is China. And this chart here just shows China, so the mainland manufacturing PMI and the Taiwan manufacturing PMI. And why do you look at the both of them? Or why would I look at the two of them? Well, I like to look at multiple data series to try and confirm trends, particularly for China, where sometimes there are some questions about the quality of the data. I mean, look, there's always questions about quality of economic data wherever you look, but one way around that is to use multiple series, and here we're seeing clear confirmation that there is this bit of a slowdown underway in China at the moment. I've talked a lot about the forces that have been shaping that, and some of those are the previous policy tightening that's still flowing through. Obviously the tariffs are having a negative impact, certainly at least a negative impact on sentiment, but also on activity. And then exports and property prices have been sort of topping out, so that's also having a negative impact there. I think China is going to be key for how the global economic cycle unfolds from here. And, it's a really interesting dynamic for China, because sometimes you actually would rather see a more significant slowdown than a small slowdown. And the reason why that would be is because if you get a bit more significant slowdown like in 2015, then the policymakers are going to take a much more aggressive approach to actually turning things around. So from a risk asset standpoint, certainly with emerging markets and commodities, that's the kind of thing that you'll be looking for some sort of long or buying signal there, but we're not there yet. Bonds, starting to see bond yields looking like they're about to break out. Meantime, bond volatility is shrunk and crunched down to almost record lows again. And just written here that my view is low volatility does not mean low risk. And that really is a key point, because whenever you've had this crunch down in volatility, whether it's the bond market or other markets, it often takes place before a larger move unfolds, and I don't think that this right here is an exception to that little rule of thumb. So keep an eye on bonds, especially when you look at the next chart, which is the US 30-year bond yield. And just eyeballing of that chart, you can see that it's moved up to a pretty key level there. I mean, whenever you get a breakout at this stage of the breakout, you know, you always question it because it can be a false breakout. We could easily just go back down. But when you're looking at such a key level and you see such a breakout, and just looking at the chart looks like a trend change. So I think that's really quite a key chart to be mindful of really at the moment. And a lot of people have been calling a break higher in bond yields, or a bond bear market, I think, for much of the last few years, and you know they've been tactically right. Um, but I'd say for the moment, for the most part, we haven't really seen certainly any kind of catastrophic turnaround in bond markets. Certainly not calling that myself, but I would say that we're if if ever there was a time for something like that to happen, we're probably at that time right now. So uh, definitely it murkies the outlook for cross-asset investing right now. And a good way to wrap that up, sort of on that note, cross-asset investing looks like investors have got the lowest allocations to cash in either for the cycle or on record, depending which metric you look at. And basically, I mean, we're not at zero on cash, just would point that out, but holding cash, or certainly being overweight to cash, is basically a contrarian view at this point. And I'll leave it at that for you to ponder. So if you've got any questions or comments, leave them in the YouTube section below. Otherwise, subscribe to the channel so that you can get these updates in the future.